Good morning, everyone. It's 10 o'clock, so I will call the September 13th meeting to order. Number 2 on our agenda is approve the minutes of the meeting of August 9th, 2018. Have a motion and a second on item 2. All in favor? Aye. All opposed? Motion carries. Item 3 is our presentation from Louise.
She is not here. I haven't heard from her. I don't know if she had trouble with her flight this morning.
Okay.
With all of the...
Here she comes.
Okay.
All right.
Maybe that's...
Well, we may give her a few more minutes.
Yeah.
Go ahead.
Can we go on with the agenda? We don't have to move to go in. To keep it. We'll give Louise a couple minutes. We will proceed with item 4, which is the consent docket. There are 2 items. I have a motion and a second on item 4. All in favor? Aye. All opposed? Motion carries. Item 5 is to ratify approvals. We have 1 item. I have a motion and a second on item 5. All in favor? Aye. All opposed? Motion carries. Item 6 is to approve the claims docket. I have a motion and a second on item 6. All in favor? Aye. All opposed? Motion carries. Item 7 is to approve the following applications for service retirement. We have 5 applications. I have a motion and a second on item 7. All in favor? Aye. All opposed? Motion carries. Item 8 is to receive the report of death, authorize the payment of the $5,000 death benefit, and approve continuation of the pension to the spouse. We have 2 cases. I have a motion and a second on item 8. All in favor? Aye. All opposed? Motion carries. Item 9 is to receive the report of death and approve continuation of the pension to the spouse. We have 1 case. I have a motion and a second on item 9. All in favor? Aye. All opposed? Motion carries. Item 10 is to receive the report of death, authorize payment of the $5,000 death benefit, and authorize the Secretary to make necessary changes to conform on the following. We have 3 cases. I have a motion and a second on item 10. All in favor? Aye. All opposed? Motion carries. Item 11 is to receive report of death, authorize the Secretary to make necessary changes to conform on the following. 1 case. I have a motion and a second on item 11. All in favor? Aye. All opposed? Motion carries. Item 12 is to approve the request of the following to terminate vested rights and commence drawing retirement benefits. 1. I have a motion and a second on item 12. All in favor? Aye. All opposed? Motion carries. Item 13 is items for individual consideration. Item A is the Securities Monitoring and Litigation Guideline. Hopefully everyone's had a chance to take a look at that. Not to oversimplify it, but the administrative committee got together and with Wiley and Renee's help put forth these guidelines. Essentially, if it's a domestic case, we're going to set the threshold at $100,000 loss, and if it's a foreign case, we're going to set the threshold at $200,000. Does anyone have any specific questions? Hearing none, I'll entertain a motion on item 13A.
Second.
I have a motion and a second on 13A. All in favor? Aye. All opposed? Motion carries. Item 13B is commitment of $15 million to the Warburg Pincus Global Growth Fund.
This recommendation is consistent with the approach we've taken as private equity funds that you're in come back to market, and we still have conviction in that firm and strategy, making a recommendation to commit to the next fund. Warburg Pincus is a global growth equity fund. What we've tried to do over the last several years in going to direct funds instead of fund of funds is have more growth equity represented by Warburg Pincus and more value distressed equity investing represented by Apollo. You'll see in the handout the private equity review and recommendations. One of the things we want to look at with private equity, if you turn to page 7, the last page in tab 1, is this pacing plan. And so what we're looking at here is you have a target of 5% to private equity. In order to get there, it's not like other asset classes where you just take 5% of your assets and invest it. It takes time to get there. So the management of that allocation is done through this pacing plan. You don't have control over the timing of when money is actually invested or comes back to you. What you do have control over is the commitment pacing. So we want to test that, and what we're showing here is if you go down the column that says present, that's roughly, I think that's at the end of July or June, $731 million at the total portfolio. Private equity represented 4%. We make assumptions in this model based on your existing private equity portfolio as with respect to the waterfall of money going in and coming out based on what we know about those portfolios and the time horizon they have left. So those numbers and projected contributions and distributions reflect your current portfolio. There are estimates, of course, because we don't know exactly. And then we plug in numbers for new commitments, corporate finance generally and venture capital generally. Warburg Pincus would actually fall in between the two, a little bit of venture and growth equity and some corporate finance or later stage investments. But that pacing plan, what we're testing is to see if we put this much money to work, are we going to get over-allocated to private equity? Are we going to reach our target in a reasonable time frame without getting too over-allocated? And we make some assumptions about the portfolio growth roughly at 3.5% to 4%, because that's assuming you're taking money out to pay benefits and things. So based on this analysis, we're comfortable with about a $12 to $15 million pace per year. This is not, it's dependent on when funds come to market that are attractive. So the calendar year, we're not going to just say, well, 2019 it's got to be within that 12 months. So this Warburg Pincus fund is in the market now. They're going to have a single close in October, and that's why we have to be here today. So the fund that we're talking about, oh, first of all, before I get to that, page 9 shows the evolution of your private equity program. You're still in what we would consider fairly early stages of the development of this program. Private equity is included in your portfolio as a return-enhancing strategy. For the difference, big difference in private equity and public equity is the illiquidity of private equity, back to the fact that you can't get your money out at any point in time. It's locked up for a longer period of time. For that illiquidity, investors demand a premium return. So it's a return-enhancing strategy. As a long-term investor pension plan, you have the benefit of investing in long-term assets. These are really long-term assets that can provide that illiquidity premium. But it takes time to build. What page 9 is showing, you began your private equity program in 2009. So the light blue, it's hard to see in this light, the lighter blue is dollars going in by year when you're actually making investments or capital's being called. And you can see how that's grown. The darker blue is money coming back to you. So when these private equity funds that you've invested in. They've invested in companies. They've improved those companies. Those companies have matured. They've sold them, and then they distribute capital back to you. So over time, it starts to rejuvenate itself, the private equity program. The green bar is the current value. So you can see the total value, distributions plus invested capital, when you look out in June of 2018, that bar is well above where the green line is. So the total distributions back to you plus what you've invested has exceeded your net asset value. It's summarized here at the bottom. Since the inception, you've invested $35.5 million, now has a value of $55 million, 19.6 million more than the cost basis. So it's appreciating as it should. One of the things when I'm looking at this, so we started this in 2009, and when we do asset allocation, we're realistic as to that it takes time to ramp up a private equity program. So as opposed to modeling 10% in private equity, we generally start with a 5% target because it's going to take you some time to get there. You're really there now. I think I know we looked at asset allocation last month more just as a check on your assumed rate of return, not in terms of any asset mix. I think it probably appropriate as we do some asset allocation work, and then the next time we do some asset allocation work, we look at what happens if we bump up that private equity target a little bit. As a long-term investor, having a little bit more in private equity can have an impact, certainly. So something we want to look at. Page 10 just looks at the actual funds and the period of when you invested in them. You see you're in 2 Warburg Pincus funds currently, a November 2012 vintage fund and a 2015 vintage fund. You've made $7.5 million committed to the 2012 fund. There's 0 remaining commitment. That's fully invested. You might say, well, how do they invest more than we committed? What happens is if they have early realizations where they send capital back to you, they have the right to recycle that capital and put it back to work. You actually get a benefit of that because you're paying a fee on your original commitment amount, but they're actually able to put a little bit more money to work on your behalf. Because money comes back and then they recycle it if it comes back. It's at their discretion, but it's a typical term for private equity funds within the first 3 years. If they make distributions to investors, they can recycle that capital.
And with what you were describing, then it doesn't change, because we're paying on committed capital.
Correct.
Or fees. It doesn't change the amount of committed capital. It still remains the same.
Right. They're just able to put more money to work for you. That fund today has, it's distributed back $4.8 million. So over half of your original commitment has already been distributed back to you. So it's a pretty successful fund, and it's still only 6 years old. $6.8 million in remaining value. The total value, that's the ending value plus distributions. So that net multiple to cost as of today, it's at about $1.47. A net internal rate of return of 13.6%. That's very good for a fund of that age. It's still fairly young. The 2015 fund, much younger fund, you made a $10 million commitment to that. Contributed 5.3, so a little bit over 50% called. There's still about 4.6 million to be called. Very limited distributions in that fund. It's 3 years old at this point. You'll start to see distributions from that going forward. Still a little bit over cost at 1.12 multiple and a net IRR of 9.6. Page 12 is a good diagram of what this portfolio looks like today, your private equity portfolio. So originally, you had invested in a Mesirow private equity fund of funds. That's invested in 15 to 20 underlying funds covering a broad swath, but you have 2 layers of fees there, the underlying funds and the fund of funds. We're trying to capture more of the market by utilizing these 2 very large global private equity firms, Warburg Pincus and Apollo. You also have the Singular Guff on the distressed side. They're doing, that is a fund of funds, but it's more niche-oriented, investing in distressed companies. It's a little bit more cyclical and opportunistic to add value. Not to say that as you grow and if there's opportunities arise, we wouldn't look at some other pieces to fill this out. But right now, just based on your size and what we're doing, we think Warburg Pincus and Apollo really covers the spectrum, and they're great global firms. So finally, our recommendation would be to make a $15 million commitment to the Warburg Pincus Global Growth Fund, which is their new fund. It's designed to continue their long-standing approach to global growth equity, primarily in 5 sectors: energy, financial services, healthcare, consumer, industrial, technology, media, and telecommunications. And they do this globally. They have offices around the world. About 50% of their assets historically have been in North America or the Americas, and then the balance outside the U.S. You see on page 17 and 18 a breakdown of their track record going back to 1971. If you roll up all of the funds that they've done, the net internal rate of return to investors has been a little over 17%. This is on page 17 at the bottom, that net IRR. So very good returns. We continue to have conviction in the firm, believe that it's a good complement to building your private equity portfolio, and we'd recommend a $15 million commitment. I believe Wiley has reviewed the subscription documents. The timing is a bit of an issue. There's a final close October 12th, so you would need to have closing documents into them by then. The capital is not called then, it's just agreeing to get into the fund.
Mr. Chairman, I have a question. I'm not sure how to ask, but should we approve C before B? I mean, is C approving that we can participate in the fund?
That does make sense.
I mean, we don't want to commit money to a fund that we hadn't approved yet, I would think.
I agree. Does anyone have any additional questions for Jason? Hearing none, I will entertain a motion on item 13C.
Second.
Have a motion and a second. All in favor?
Aye.
All opposed? Motion carries. Now entertain a motion on item 13B. Have a motion and a second on 13B. All in favor?
Aye.
All opposed? Motion carries. At this time, I'll invite Louise up, and we will go back to item number 4. No. Item number 3. Good morning.
Thank you for your patience this morning. My cab driver was very leisurely, and I pride myself for being a punctual person. I'm rarely late. I checked my phone when I came in, and it said 10:01, so my apologies for being tardy. But, I'm very pleased to be here today and to have this opportunity to talk about the results of our work, namely the 2017 actuarial valuation of the pension plan. And as you know, each year we do an actuarial valuation, which is a calculation of retirement system liabilities and the determination of a contribution that is sufficient to pay off those liabilities in an orderly manner. And one of the main results of our work is shown on page A-2 of your report, namely the contribution for fiscal 2020. So we do our calculations as of the last day of the plan year, which for the purpose of this report is December 31st, 2017. But the contributions are used for a future budget year. So for the purpose of this report, they would apply to the city's, we would say, fiscal 2020, which is the budget year beginning on July 1st, 2019, and ending on June 30th, 2020. And this lag gives the city, Craig and his people, time to budget for upcoming contributions. And so you see lots of numbers expressed as percents here, which is fairly common for a system like this that is open to new city employees. And as a practical matter, when making the contribution, these contribution rates are applied to plan member payroll and then paid into the pension trust periodically throughout the year. So the recommended contribution for fiscal 2020 is 5.56%. And just looking at the chart on the bottom of the page, you'll see two columns, 2017 and 2016. Those are the valuation dates. They correspond to fiscal 2020 and 2019. And you can see that the contribution increased by about 1/3%, a relatively modest increase, particularly in a year when we had assumption changes. And we valued those assumption changes to increase contributions by about 0.9% of pay. And as you may recall, we lowered the investment return assumption as well as the wage inflation assumption. The reason the contribution increased by 0.1% of pay is because of the favorable experience of the pension plan. It helped to offset the cost of improving the assumptions. That favorable experience actually relates to plan member pay. We have assumptions in our valuation about the rates at which plan member pay is assumed to increase. And during calendar year 2017, those increases were lower than long-term expectations. So from an actuarial perspective, that means that our assessment of liabilities is now lower than what we thought it was going to be last year. So good news for the pension plan, maybe not so good news for the plan members. But the impact on contributions was favorable. And in terms of dollars, we see numbers expressed as percents of pay. But for fiscal 2020, that 5.56% of pay, we would estimate to be at about $7.4 million in city contributions. So an increase over the prior year, perhaps of in the area of $400,000. You may find that the reason for the increase is a little counterintuitive, since typically the biggest driver of plan changes from one year to the next in terms of experience relates to the investment performance of the fund. And 2017 was a great year for investments. Most pension plans that had diverse portfolios did well in 2017. But for the purpose of the work that we do, we don't use the market value of assets. We use a market-related value, which phases in investment gains and losses. And during the prior 3 calendar years, there were some investment losses, which we'll talk more about in a moment. So as a result, the investment experience of the fund recognized in this report was not great. It wasn't horrible, it just didn't meet expectations. So it's really the lower than expected pay increases that are driving the favorable experience. And on page B-3 of your report, we have a summary of pension trust activity during 2017. This information came from the, I believe, audited financial statements. And at the top of the page, you can see the revenues of the plan. So this shows for 2017, 16 as well, contributions from plan members and the city of about over $15 million. We had over $107 million in investment income. And then we have expenditures, which would be the benefit payments paid out of the trust for current retirees. You have over 1,500 retirees receiving pension benefits totaling over $33 million. You also have refunds of employee contributions for people that leave city employment without earning a benefit. They're always entitled to a refund of their contributions. And so we end up at the end of the year with an increase overall of more than $84 million. And the rate of return on planned investments during 2017 was over 16%. So our calculations are probably a little bit different than Jason's, since we subtract off investment expenses and the administrative expenses of the plan, since the actuarial assumption is that the investment return will be sufficient to cover all expenses of the plan. And at the bottom of page B-3, you have sort of a sketch of how pension plan assets are invested, just in broad categories. On page B-4, we have the development of valuation assets. So for the purpose of our report, this is the asset value that we're using is shown at the bottom of the page in item G, $721 million, which is different than the market value. The market value of assets at the end of 2017 was over $742 million. That's item B. Item C shows the market value at the beginning of the year. So you can see that there was appreciation. The expectation was that the fund would earn $50.5 million. That's in item E2. But in fact, it was a really good year for the plan, and you earned about twice that, more than twice that, over $104 million net of expenses, item E1. So what this asset smoothing method does is it looks at what was expected and what actually happened, and that difference, which is shown in item E3, the $53.6 million, that difference gets phased in over a 4-year period. So for 2017, we take 25% of that. And then we look at what happened in 2016. We take 25% of that difference, and so on and so forth. But looking at item F, the numbers in brackets show that there were investment losses. So it doesn't mean necessarily that you lost money. It just means that you didn't hit your actuarial bogey. So the returns that the system saw were lower than long-term actuarial expectations. And it's really that difference that's getting phased in over the 4-year period. So the result is a recognized rate of return shown in item I of just over 7%. But remember, for calendar year 2017, the expectation was that the fund would earn 7.4%. The assumptions that the board adopted will be effective for 2018 and beyond. So technically, we have what we call an investment loss. Even though you had a really good year on investments, you still have to pay for the losses from prior years. Item H shows really when you phase in investment gains or losses, it means that you haven't fully recognized all of the pieces. And so for a year like 2017, where you have good experience, we have some unrecognized investment gains that we haven't recognized yet. And for the next 3 years, we expect to phase in next year's valuation. We'll have like $21.7 million in investment gains that we'll be phasing in over the next 3 years. So if in 2018 you have a good year on investments or you meet the actuarial return, we'll have some investment gains that we'll be recognizing, which is, certainly good news. On page A-5 of your report, we have some comments related to the valuation. So as of the valuation date, December 31st, 2017, the retirement system continued to have a funding surplus of over $24 million, which means that the value of benefits earned to date, the liabilities associated with that, were less than the value of assets held in trust. That funding surplus we amortize and we use as a credit to reduce city contributions. That's the retirement system's policy. and frankly, a fairly common policy among public funds. So that credit helped to reduce city contributions to 5.56% of pay for fiscal 2020. But to the extent that you use the surplus to reduce city contributions, eventually it'll go away. It could also go away because you have bad experience in the future as well. So when that happens, the city contribution is expected to go back up to the normal cost rate at a minimum, which is currently 6.72%. It might be a little higher than that if you have an unfunded that emerges. And so that would be an increase in contributions of about 20%. So it's more of a cautionary note. The surplus is not expected to stick around forever. I hope that it does, but probably it won't. And it's just from a budgeting perspective, something to be aware of. I think one of the great things to report is that the retirement system continues to have a strong funding percent. As of the last measurement date, it was 104%. And I'm always curious about how this system compares to other systems in the state, particularly the statewide systems. And with the exception of the judge's plan, which is a pretty small plan, with a funding percent, I think, of about 112%, your system is better funded than the other statewide systems. So it gives you bragging rights. The strong funding position and strong financial health of this system, I think, is really a result of the good governance of this board and the good decisions that you've made over the years. On page A-4 of your report, you can see a history of about 20 years of the system's funding percent, and it's shown in the far right-hand column. And this is really good. It's indicative of a system that's well run. I wish that all public funds were managed this well. But in 1998, you can see a funding percent of 109%. In the late 90s, it was fairly common for systems to have funding surplus, just given the booming financial markets of the time. It sort of mirrors the performance of the financial markets. See the dot-com bubble burst and your funding percent starts to drop as investment losses are recognized and phased in. It starts to pick back up again, and then you can see in 2008 it starts to drop back down when we entered the Great Recession. But this represents a fairly strong financial position over the last 20 years. I think that concludes my prepared comments. I'm happy to have good news to present to you this morning. Can I answer any questions, any comments?
So I want to make sure I understood one thing, Louise.
Sure.
The changes in the assumptions, that is included within this document, right? So when we're looking at 104, it's with those changes in assumptions?
It
Okay.
is,
Okay.
yes. And when I looked at the other systems, I noticed that for a couple of the systems, the assumptions they were using were not nearly as strong. So you're in a better funded position in using assumptions that are more conservative. So when you improve the investment return assumption, for example, you're really potentially understating liabilities. You're lowballing them, which can inflate the funding percent. The OPERS system has assumptions that I think are comparable to this system, but they have a lower funding percent. It's just under 100, but they do fully reflect the new assumptions.
Okay, thank you.
Mm-hmm. Other questions, comments?
Louise, on page B3, expenditures, line D, investment expenses,
Yes.
what's included in that line?
I think that they would include investment consulting expenses, and probably to the extent that some of the money managers, possibly their expenses as well. So it's,
The others are. Thank you.
Question on page A6. Will the years to amortize continue to go down till we get to 20 years? Okay.
right, it's going to continue to roll down, and I think at some point, we would not want it to go down to zero. That's not really a common practice. If you continue to have a funding surplus, what we may suggest or recommend would be keeping the funding period at the same level. So maybe it's called a rolling or an open amortization period at maybe 10 or 15 years. And the reason you would do that in an overfunded system is to preserve the funding credit. Because when you're amortizing something and you keep resetting the period each year, you're basically not using up the credit or paying off the debt. But it's a board decision. Other questions? Thank you.
Thanks,
for your
Louise.
attention.
Moving along on the agenda, item number 14 is the investment consultant report. Jason.
Okay, you have the August ASAP there in front of you. For the year to date, we're up about 3.5%. You know, it's great. Usually, we come in sometimes when we don't hear great actuarial reports, but then the markets have done really well, and so we can come in and say, oh, things are changing. But you got a great actuarial report, and we're probably going to be talking more about where we are late in the cycle and nervous about what direction markets are going. That said, overall, your portfolio is up 9.3% gross of fees for the 1 year, really led primarily by U.S. stocks, U.S. large cap and small cap. We've seen a big dispersion between growth and value. Globally, growth has significantly outperformed value, although that's starting to mitigate a bit. U.S. dollar strength has helped your U.S. investments. It's been a headwind for a lot of other pieces in your portfolio, particularly emerging markets, equity, and fixed income. This the month of August was really difficult for your global bond manager, Brandywine, down about 2.5%, and that's primarily currency. The impact of currency on the MSCI Emerging Market Equity Index for the year-to-date through the end of June was about 11%, 11% negative for just because of currency. So that's been a pretty big headwind. Fixed income is starting to flatten out. We're seeing you're actually getting positive returns now in bonds as yields have moved up a little bit higher. I think probably in terms of the negative side, we're not necessarily out of the woods, but you've got a little bit more coupon to offset any increases in rates on a go-forward basis. Interestingly enough, if you look at your cash return for the 1 year is up 1.5%, whereas the Barclays Ag is down 1% on a year basis. So you're not necessarily being penalized as much for cash. Not that you have an allocation to cash, but shorter duration bonds are providing protection and a little bit more coupon. The asset allocation on page 1, you continue to be overweight to U.S. equities, as that's what's done the best. So for cash needs, our recommendation is to be taking your cash needs out of your large cap portfolio. That's 4% overweight. Small cap's about 3% overweight. From a manager standpoint, if you go to page 2 and just look at composites, you can see that on the 1 year, your large cap up almost 19%, slightly trailing the index, and small cap up 21%, again, trailing the index, which is up 23%. It's good returns. We're not concerned. It's Times Square is trailing a bit in the growth space, but still up 26% on the year. They're your best performing manager on an absolute basis. They typically aren't going to keep up in that type of market environment. Your international development managers, Harding Loevner and Lazard, have both done well on a relative basis. Harding Loevner, the growth manager, really performed well, and overall, the international portfolio up 10% relative to the benchmark, EFI up 4.9. Emerging markets has been challenged, as I mentioned, and both Wasatch and Wells are not immune in that space, but nothing that's causing us concern about what they're doing. So overall, performance still is positive. We're going to talk a lot I think at the OpTech conference, you'll hear a lot from just the overall macro views about more near-term concerns. I think there's a perma-bear speaker that's speaking on the last day, and then we're going to do a session on just late cycle investing and where we think we are. While economic signs are positive, we think we're pretty long in the tooth and wanting to make from a relative valuation standpoint and where we see opportunity, we're really neutral on everything to our long-term expectations, not suggesting that there's anywhere that's real attractive or real unattractive right now. So more neutral, and that's consistent with this late cycle. The last thing I wanted to touch on, and this is not on the agenda, but I had talked about this when I was here in June, and we were making the recommendations on the long-short equity portfolio, the new Mauna Kea portfolio. We said we would come back with some liquidity parameters, proposed liquidity parameters. We can add, just for discussion today, but we can add it based on your input, agenda item next month to include it in the policy. But if you look at page 3, this is what, I don't know why it's page 3 when it's the first page when you open this. I guess it's the cover is always 1 and then the back is 2. This diagram is incorporated into your guidelines. At the bottom in the table, these were incorporated into your guidelines with the exception of that grade section on liquidity. This is what we're proposing. So liquidity, remember what we're talking about is the funds that you're going into on the K2 Mauna Kea platform, you're getting the liquidity of those underlying funds. It's not the same as when you're in a fund of funds and that fund of funds has liquidity provisions. You're in a unmanaged fund of funds that passes through all the terms of the underlying funds to you. So we just want to make sure everybody is aware and put some parameters around that. So what we've proposed in this is in the guidelines. We have to think about this in a couple of different ways because most of these funds, when you go into them, there is a 1-year lockup, meaning you can't get out for 1 year. After that first year, then the liquidity provisions change. So these guidelines are written as of initially. So what we're proposing is at least 25% of this total portfolio be liquid quarterly, immediately. When we say liquid, that means you could redeem and get out on a quarterly basis. At least 60%, and this is stacking on top of one another, annual or more frequent. So from the initial investment that when you initially went into Mauna Kea, at least 60% of that you would be able to get out within 1 year. At least 80% within 2 years and 100% within 3 years. And no more than 15% in funds with greater than a 2-year lockup. You may recall there is a fund that we had talked about that you're not currently in, Cevion, which has a 3-year lockup. Cevion is a European activist fund, meaning they get very involved in companies that they invest in. They invest in 10 to 15 companies and take a very active role. The nature of that strategy is a little bit longer term, and that's why they have a 3-year lockup. It's not in your portfolio today, but this would allow for that. Now, the initial funding weights, so the guidelines are what we proposed on the left. On the right shows where we are today, and actually the next page probably shows this a little bit better. On the left is what your current portfolio is. This does not include Cevian. I don't want to get too hung up on Cevian because we're not going to talk about them today, but the current portfolio, as of today, 37% is you have quarterly liquidity. You could get out next quarter on. So that's well above that 25% threshold. 86, almost 87%, we could get out after 1 year. 94% within 2 years. So Red Mile, one of the managers, it's a healthcare-oriented manager, has a 2-year initial lockup, and then it goes to quarterly after that. 100% after 3 years. In 1 year, 1 year from July, when you went into Mauna Kea, the liquidity changes dramatically because all of those funds with a 1-year lockup roll off. So with July of next year, 68% of this portfolio would be liquid on a quarterly basis. 95% or 94.5% within 1 year. So the point is, this is very liquid portfolio. But we want to we're identifying this so we have some parameters around which to build this. It's also important to remember this is 10% of your assets. So if you were to adopt this and these guidelines would allow for a Cevian to be in the portfolio, Cevian has a rolling 3-year lockup, meaning once every 3 years you can get out. And so once you hit that 3-year date, if you don't get out, then you've got another 3-year lock. Our proposed portfolio has 8% in Cevian. So it's 8% of 10%, or about 80 basis points of your total assets. What Cevian is offering really within this portfolio is shown on page 5. We're not banging our fists to say we have to have a fund that has a 3-year lock. We like this strategy and what they do, and having a 3-year lock in that type of strategy makes sense because it's very concentrated in what they're trying to do. But you'll see on page 5 the difference, and this is at the bottom, in terms of characteristics. And really the only difference is in the European exposure. We're getting a little bit more European exposure. With Cevian in the portfolio, we would have 23% instead of 18% European exposure. We can rejigger it. There's other places where you're getting non-U.S. exposure, AKO for one, as well as some others. So I don't want to get too down in the weeds on the manager. Really what we wanted, you had asked about these liquidity provisions. We thought it was appropriate to define that and make sure you're comfortable with it. So I guess I'd like to get your feedback on whether or not you're comfortable with that or not. I guess the alternative would be we could tighten that up and just tighten it up under 2 years to be right where we are today, and not have any percentage over 3 years. So this is for discussion.
I'm sorry. Is this something that the administrative committee would meet to discuss?
No, it will just be on the investment policies for the board to review next month.
Okay. Okay. Then we'll do that.
So Jason, I got a question on, so you're talking about the one that has a 3-year lock. Is there anything that would prevent us, like we have, if I go down the list there on page 4, the parameters, no more than 15% in funds greater than 2 years lockup. Is there anything beyond that that we would?
Well,
put in
so that's
place? Is
why
that
we
part
then
of the
put-
question?
Well, it's 100%, the parameter above that, 100% within 3 years.
Okay, so that puts the cap and
Yes,
says
that
there's
puts-
nothing more than.
You couldn't
3
have
years. I got it.
anything more
Okay.
than that.
Okay.
Within a 3-year lock, okay.
So from day one, 100% of the portfolio would have to be liquid within 3 years. At any point in time, you couldn't have any more than 15% of 10% in fund, I think
Right.
that's the way you have to think about it. This is not creating a lot of illiquidity in your portfolio, like private equity is. It's just there are some hedge fund strategies out there that are doing some things that make sense to have a little bit longer lock based on what they're doing that we think may be beneficial in this portfolio. And you had these types of strategies in the K2 overseas fund that you were in. It's just different when you're in a commingled fund of funds with other investors. You're getting the liquidity of the fund. And if they'd been in there and there's other investors moving in and out that create flows that can provide liquidity, this is a little bit different in that it's like it is your own portfolio. So just want to make you aware of these things and make sure that you're comfortable with that.
And that's why we're approving specific guidelines
Yes.
to this, because it's just a different structure now.
Yes.
That before, it would be a structure like that within the definition of a fund that we're buying.
Yeah, and you get whatever the fund gets. You're buying what they have. So you have the ability to customize this, but within that, we want to make sure that we've got parameters that you're comfortable with, so that when we come to you with, we say, well, we think Sevion should be in there, and you say, well, we don't want there to be we don't want it to be an issue if we say, well, now we need to get out of Sevion, but we can't get out for 2 years, or you can't get out for 3 years. We know going in that's the case.
And presumably with the strategy now where you all will be more actively managing this,
Yes.
that ACG will, that if you came to the place that Sevion, there were concerns with management or whatever it is, then you would target that date, bring that back to
Yes.
us as a recommendation.
Yes. And that's going to be in reports. It'll be included, like what you're seeing on page 4, where we are in terms of liquidity. So really, depending on, we'll come back and, you could approve these guidelines and then still say, no, we don't want to do a Sevion. We're not comfortable with that. But still have these guidelines. Or we could tighten up the guidelines if you say, well, we don't ever want to consider a fund with a 3-year lock. Then let's tighten up these guidelines.
Do other funds have rolling locks like that? You talked about some that's like initial, when you get in. Do other funds have similar structures, maybe not as long?
This is other concentrated funds like this could have lockups like this. Sevion has another share class that's not on the platform, not on the K2 Mauna Kea platform, but the fee is much higher. So it's the same fund, different share class that you can get out on a 1-year basis. It's a 1-year lock, but the fee is, it's almost double what this fee is. So when working with K2 on this, it was determined that if we're going to include Sevion, the lower fee structure would be better because that 3-year lock makes sense for this type of strategy. But we're getting feedback from clients that just when we talk about a 3-year lock, they question that. So we just want to make sure you're aware.
Jason, on the 3-year lockup, one more question. On the no more than 15%, so every third year that percent's going to go up, correct, with Sevion?
Well, I think the way we've talked back and forth about this, it's really if you have Sevion in your portfolio, you have to look at that as always a 3-year lockup.
Right.
There is a day,
Right.
once every 3 years, where you can get out. But we would manage that to never let that be above, well, it's really not going to be above 15%. it's not going to be above 6 or 7%, because Red Mile as well has a 2-year lockup, but that after 1 year,
It falls off.
that falls off and it doesn't reset. That's the difference, the Sevion reset. So we would, what we're suggesting is that Sevion would make up 7%. So really, you're going to be a lot more, that's on back to page 4, if you included Sevion, after 1 year, you'd have 87.8% of the portfolio would be, you could liquidate it within 1 year. So almost the entire thing. And then really at that, you'd have a small percentage, or a fund that has a longer lockup.
Any further questions? Thank you, sir.
All right, thank you.
Item number 15 on the agenda is comments from board, staff, and citizens. Next week is the week after next. That's what I'm rushing things. I just want to let everybody know that I may or may not be in attendance. My daughter-in-law's due date for our second grandchild is the 25th. So she was 2 weeks late on the first one. So, but from what she's telling my wife, that's probably not going to be the case now. So hopefully I can get there for a day or two, but I'm just going to, at this point, I'm going to play it by ear. So just let everybody know. Okay, item number 16 is adjournment at 10:57. Thank you.